Hey everyone, happy Thursday, September 25th. It's about 10 a.m. on the West Coast, and it's time for another market update. Well, it's been an interesting week. Conversation I've had to have quite a bit, and we talked about this last week, was why did mortgage rates go up after the Fed cut their rate? As we talked about last week, there's a couple reasons. The main reason being that, mortgage rates had already, come down ever since they were confident that the Fed would make that rate cut. So all the benefit that we would get in mortgage rates had already happened going into that Fed rate cut announcement. And the second part is that at the press conference after they made their cut for the month in September, Chairman Powell didn't say things the markets liked. He made it seem less sure that they would cut going forward, how many cuts we'd be doing going forward. And obviously, we want them to cut rates as much as possible every meeting they have for as long as it makes sense. So that is one reason why mortgage rates actually ticked up after that. I think going into the meeting, we're about 6.13, and they cut their rate by a quarter point, and mortgage rates within a day had gone up by about a quarter point. So it doesn't always make sense, but just keep in mind the Fed rate and mortgage rates are not the same thing. Two, we had already come down quite a bit. And three, again, Chairman Powell needs to say nicer things. We need the data kind of go in our favor to make sure they keep cutting. That's what we want, to keep cutting. So getting into this week, now that we're past that, first we got August new and existing home sales. So existing home sales for both new homes, where we'll go over first here for the month of August. Month over month, it was up about 20.5%, which is a huge number. Year over year, we're now up 15.4%. So these were really big numbers. You can see that on the graph just jumped up. 20% in 1 month is a big jump. So it's very interesting to see if this continues. And again, this was before rate cuts and rates had come down a bit. People buying a home in August were probably shopping in July. So again, a really big number, almost so big that you can't take it seriously. We'll have to see what next months look like and going forward. Next one we got was existing home sales. So this is for the month of August for people that closed on an existing home, not a new home, and actually closed. And so if they closed in August, they probably were shopping and locking their rate in June or July. So again, before rates had dropped, month over month, it was down about 0.2%. Year over year, we're up about 1.8%. At about a 4.6 month supply, which is basically balanced, the way we look at it. 31 days, days on market went up a little bit. So overall, again, the home sales have been pretty slow. Anybody in the industry will tell you that. And again, it's going to depend on your region, but with rates as elevated as they had been, then that's definitely slowed things down. So it will be interesting to see when we get September's numbers. That would be people, more likely that would have locked in the month of August, and then October we're going to start seeing people that month, maybe locked at the beginning of September when rates were coming down. So as these go forward, we should see a little bump up, with that nice little, bounce down that we had in rates. But for the time being, home sales are what they have been, pretty flat. Next thing we got was August starts and permits. So this has to do with new construction, basically new permits that are pulled for new housing, homes that were started construction of, homes that are under construction, and then completion. So they still tend to be down across the board. Year over year, they're all down, as you can see. Month over month, completions jumped up a little bit, but still down 8.4% year over year. Permits and starts, that's, we can kind of get an idea of future inventory. That's at about 1.31 million. So it's gone up a little bit from where it was, but we're still far below what demand is. Demand is household formation, and that's been running on average more in the 1.7, 1.8 million. So if we are only building about 1.3 million homes in the next year and demand's over 1.8, that is a good thing for homeowners. It's not good for supply. It's not good for people that want to see house prices drop, but it's good for current homeowners. It's price supportive. Next thing we got. So today we got the final look at quarter two of the United States GDP. And it came in at 3.8% growth. It was at 3.3% previously. So that was stronger than expected. Not necessarily good what we want. Again, the stronger the economy looks, the less likely it is the Fed will cut rates. So, this was not necessarily a positive development for us. Not that we don't want the economy to grow, but again, what we want is the Fed to cut. Fed won't cut if everything looks great out there. Next thing, initial jobless claims. This is actually a big, a negative one for us today. It had been kind of ticking up, if you remember. It had been in the 230s and the 240s. 1 month it jumped, or 1 week a couple weeks ago, it jumped up in about 260. It dropped this week. It was supposed to be about 233, came at 218. And the reason this is such a negative is one of the reasons the Fed cut and says they're going to continue to cut is the labor market is showing weakness. So if people are getting laid off less, then maybe the labor market, the way the markets are looking at it is maybe the labor market isn't as weak as the Fed thinks it is. So, we again don't want to see people lose their jobs, but the weaker these numbers look, or the lower these numbers look, the stronger the job market looks, and the less likely it is for the Fed to cut rates. Remember, we want inflation down, we want jobs high, or I'm sorry, jobs, job growth, not too crazy, and that will make it so the Fed would cut rates. If jobs start to show major weakness, that's when the Fed will expedite that and cut rates a little faster. So again, we want a balance, right? We don't want everybody to lose their jobs, but we also don't want we want rates to come down. So that's where we're at there. So where does that leave us? So the average 30-year conventional this week is at 6.39. Last week was at 6.37. I think when we did the call, they hadn't updated it yet, or when we did this video, it was about six. I was thinking about 6.25 to 6.3. It actually jumped all the way to 6.37. So again, mortgage rates going into the Fed cut 6.13, the day after the Fed cut 6.37. So 0.24, basically a quarter point that the Fed had cut, we got increases in mortgage rates. So going back to the beginning of the video, that's for multiple reasons. But so we're going to have to hope the data kind of comes in our favor going forward. Tomorrow's the first one. We get PC inflation. We've already seen a look at inflation with CPI, so it'll be interesting. If this is a big surprise on the lower end, this might be good, but we kind of know it's going to go up a little bit. So as long as there's no big surprises, things should kind of stay the same. The big one will be this jobs report on October 3rd. Again, the Fed's really going to pay close attention to the job stuff. If this again shows weakness like the last one, that will be good for us. If all of a sudden the job market rebounds, according to the Fed, unemployment goes down, that would be bad for future rate cuts. Then we get a CPI inflation for the month of September on October 15th. And then the Fed will meet again on October 29th. So basically, we need all that data to come in our favor going forward. We need to show some weakness in the job market. And then that way we can be confident that the Fed will keep cutting rates. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.